I think setting the stage here is really important, right? So in a typical day, and this is just one day that I picked out of my out of my head here. On one day, Binance futures will do about $30 billion in perpetual futures trading volume, across all their asset base. On-chain perps will do about 1.5, right? Like that. This is just Binance. There are more centralized exchanges that do the same exact thing. So for us to be, and for us and for others to be focused on, like attacking one another right now on like the differences in offerings, like we're not even at that point yet. Like the big thing that everyone has to focus on is getting as many people on chain as possible and getting the offering to be as similar to centralized exchanges. We have to emulate the user experience that people like on centralized exchanges and bring it on chain.
Welcome to Into the Forest with Pine. Today I'm with Matt from Synthetics. Matt, can you kind of tell us a little bit about yourself and what you're working on at Synthetics?
Yeah, definitely. Thank you again for having me here. Real pleasure to be on. So yeah, I'm Matt. I've been a core contributor at Synthetics for, I think, oh god, it's actually officially 2 years now. Been here a long time. Been a long time DeFi guy. Been around since the early days of DeFi. I always like to say, and I've probably said this on a bunch of calls now, but I always like to say that I've been involved in DeFi since pre-governance tokens, during the days of when you could use Yearn and Curve at the same time, and we thought it was revolutionary, right? Like we thought using this this liquidity pool and these like yield bearing tokens was like this. Oh my! It was mind blowing, right? And to see how far the industry has come from there has it's just been a fantastic thing to witness. So yeah, I'm happy to chat a bit on synthetics. There's obviously a lot to chat there. I'll just give a brief overview because I know you probably got a bunch of questions on that side. So synthetics has it's a it's a very complex protocol when you look at the history of it. But the synthetics of today is a liquidity layer, and it's a liquidity layer that powers on-chain derivatives and on-chain financial instruments. The most notable and the most known of those is Synthetics Perps, which is done 35 billion plus in volume, 20 million plus in fees, onboarded tens of thousands of traders, and has I want to say about like 70 plus unique crypto assets, forex, commodities, and and so on. But really, the goal of the Synthetics Hub today is to onboard on-chain derivative developers and let them build atop synthetics liquidity and synthetics infrastructure. And that's a very different path than the one synthetics was on years ago, right? Synthetics doesn't even start with the name synthetics. It starts as Haven. And under Haven, it's I like to say it's similar to like a MakerDAO, right? And Haven is trying to solve this stablecoin, this on-chain stablecoin problem, and then Synthetics transitions into spot synth trading, very user focused. And setting the stage for that is that back in the day, in the early days of DeFi, there was very little liquidity on chain. So this ability to trade from one synth asset to another at a set spot, at a set Oracle price was a fantastic pitch in the early days. But as liquidity has gotten deeper, and as many innovative protocols have built on that space, Synthetics took a step back and really innovated on the product and saw that there was a real need for on-chain derivatives, and has with Synthetics v3 the protocol has gotten a lot more generalized, a lot more modular, and we're seeing a lot of developers and a lot of protocol interest in building atop that.
Yeah, awesome. Can you kind of start off by like telling us kind of like what's the disadvantages and advantages as using your native token as collateral rather than doing something like MakerDAO does by using like Ethereum or USDC as collateral for the different synths atop your platform?
Yeah, great question. And this is actually something that's like being iterated on as we speak, right? So the obvious problems with scaling using your token is that it's very dependent on price as to how far that you can expand the amount of liquidity you offer at like at like set risk parameters. And we've seen lots of tests throughout synthetics' history. Some of these tests have come around using like liquid wrappers. We've seen to like continue to scale the amount of derivatives that the protocol can support. We've seen governance try wrapping things like DAI, wrapping things like ETH, to be able to scale the protocol different ways. And so with that, we've seen, obviously there's ample disadvantages to doing that side of thing, and it's really just you're constraining the protocol to a level that you don't want to do. Like, maybe the synthetics in the past was able to work under that when there wasn't all that much volume. You weren't doing $200-300 million volume days. But the synthetics of today is doing leaps and bounds more than the protocol in the past. And right now, there was actually a blog post that was just released explaining the Andromeda release. And the Andromeda release, for some context here, is Synthetics v3, the core system, Perps v3, and the usage of USDC as collateral on a new chain base. So with all of that, this is a direct test of using a new collateral type on a new chain and then building in a fee share model for the token holders instead of relying just on the token. And with Synthetics v3 as a whole, Synthetics v3 is completely agnostic to the collateral type that it uses, right? Obviously, I personally, and I think governance expects SNX to continue to be a collateral type, but you'll also see this influx of USDC on base. You'll probably see, I expect to see ETH and LSTs and things of that nature also used, because at the end of the day, like, this is what the protocol needs to grow further than just perps, right? Because perps is one side of the equation, and there's a lot of volume there. There's a lot of PMF, and there's a lot of liquidity that we currently offer across these 70 assets. But if you want to go further than that, if you want to build, on-chain options, structured products, cross-asset swaps, if you want to help, protocols on L1 like Athena scale through like delta neutral perps, like, you need a lot more liquidity than just, what your native token can offer. And governance has really come around to that idea. And, with this Andromeda release, we'll have experimentation happening, live. So I would say over the next couple months, we will see what using USDC as collateral is like on this new chain, and we'll see what the scaling side looks like too.
Yeah, awesome. Kind of speaking about perps a little bit, it seems like there's been kind of an explosion of kind of new protocols trying to do on-chain perps and use and like activity in on-chain perps like as of recent. How does like synthetics kind of see this kind of going out into the future, and like how do you guys see the competitive landscape of this?
Yeah, definitely. So I think the big thing that everyone in the industry has started to notice about on-chain perps is it is one of the few areas of DeFi and of crypto that has seen like real product market fit, right? Like, it's kind of sad to say after these years, because we're kind of like recreating traditional finance to an extent, but like, we've started to find these products that people actually want to use on chain. And when you look at the competitive landscape of it, I think setting the stage here is really important, right? So in a typical day, and this is just one day that I've picked out of my head here. On one day, Binance futures will do about $30 billion in perpetual futures trading volume, across all their asset pairs. On-chain perps will do about 1.5, right? Like that, this is just Binance. There is a million more centralized exchanges that do the same exact thing. So for us to be, and for us and for others to be focused on, like attacking one another right now on like the differences in offerings, like, we're not even at that point yet. Like, the big thing that everyone has to focus on is getting as many people on chain as possible and getting the offering to be as similar to centralized exchanges, without having awkward CEOs, steal all your money. We have to emulate the user experience that people like on centralized exchanges and, bring it on chain. And with the synthetics perps v2, or as we call it now, just synthetics perps, we've seen that. Like, that is the current offering that exists, and it will continue to get better. But as of right now, you have fees that are very close to centralized exchanges. You have an asset offering that is close to centralized exchanges. You have, like the protocols that are building atop synthetics. You have Quenta, you have Polynomial, you have, Infinex coming very soon. These protocols are also building like one-click trading tools and like sign in with your email tools. Delegate to a different wallet. There's so much that they're additionally doing, atop this synthetics perps, liquidity that will continue to improve the offering and will continue to onboard traders. Just one additional note here. I think that synthetics has also pioneered this, not only building out this like amazing perps offering that has, onboarded many users, has done so much in volume, but we've also gotten to this point where risk management is top of mind, and I think we've put it top of mind for others that are building in decentralized perps as well. Like if you are to look across the industry, some perps protocols are still extremely imbalanced, and liquidity providers take a wash. If liquidity providers are taking on long or short exposure and the market goes the other way, that's a massive problem. And at synthetics, it's top of mind for the market design. And we've seen innovations like dynamic funding rates and price impact to simulate order books that have incentivized arbitrage traders to come in and make sure that these markets are as delta neutral as possible. And I think that will continue to be a theme of on-chain perps. Like people will kind of figure out like, hey, we can't just let liquidity providers take a bath, and just pray that inflation makes up for the difference or whatever some of these protocols are doing. But at Synthetics, this is top of mind. And when I say Synthetics has done, I want to say the number right now is about like 23, 24 million in total trading fees. The performance is also similar to that. Like this isn't 24, 25 million in trading fees and 20 million in trading losses, right? Like that is the overall performance. Like it is, it's a fantastic offering. And hey, at the end of the day, I hope to see others across the industry do the same thing. Like no one wants to see anyone blow up. We want to see more people on chain. We want to see, all these folks from centralized exchanges start to come on chain as well.
Yeah, that's really cool. How do you guys kind of see growing out your ecosystem and like supporting the different protocols that are building atop of you, whether it be something like Thales or something like Lyra, which is like a options protocol or a futures protocol?
Yeah, definitely. So the first test of this will actually come in the Andromeda release on base. The first thing that's going to be happening on base is that the fee share for integrate. So as I was saying, the first test of this, trying to find new ways to incentivize integrators is coming with Andromeda. So with Andromeda, the integrator fee share is going to go up to 20%. So for all volume that integrators are able to, pass through Synthetics liquidity, they'll receive a 20% fee share on that volume. Now, we like to say like, that's one benefit of building on top of Synthetics. Like there's the financial part of it. But the big part is also the fact that anyone that's building on Synthetics, the liquidity is abstracted away from them, right? Like there's a deep pool of liquidity that powers all of these derivatives. And then the next part of it is that the entire infrastructure is built out for you. Like you're not reinventing the wheel every time that you want to build a new derivative app. You just tap into the synthetic side, and all of that is, all the accounting and the on-chain standards are all handled for you. Now, the Treasury Council has gone a step further, and there's like an ecosystem of governance and synthetics, which we'll talk about relatively soon. But the Treasury Council has chatted about having this ecosystem fund that they'll use to help invest and support ecosystem projects once they start building atop synthetics and showing that they have some sort of PMF. That's when they'll start supporting them financially to some extent. But the big thing that we see initially is that upping this integrator fee share, supporting them through their success and the success that they pass on to synthetics. And then from there, supporting them across a wide array of areas, right? Supporting the liquidity, supporting the infrastructure, supporting them on comms and marketing, supporting them with the wide amount of engagement that synthetics gets, and the deep community and the years of respect that synthetics has built up can also be semi passed on to some of these projects. So hey, at the end of the day, it is a interesting problem to try to solve. It's like aligning incentives between the front end integrator and synthetics, but we're seeing a lot of testing there, and we're hoping with Andromeda that integrators are extremely happy with that side of things. For additional context here, as of right now, I want to say the fee share for integrators is about, I want to say it starts at 10%, and then it has like a sliding scale down to 5, dependent on the amount of volume that you pass through the protocol. So with Andromeda, this fee share is set at 20% flat, right? So that's this massive thing that integrators had been pushing for through governance for a while, and this will be the first test that we see in real time for it.
Yeah, we'll see how it goes. So speaking of that, like a lot of well, recently, like well, I guess not so recently now, but Synthetics kind of launched on Optimism, and there's been a lot of activity happening on layer twos. Like, how have you seen the types of activity change on L2s versus Ethereum mainnet, and kind of how do you see that kind of going out into the future?
Yeah, definitely. So the interesting thing to like think of here is that when Synthetics was on Ethereum L1, the product offering was very small, right? You had really just spot synthetic asset trading, and that was pretty much it, right? And with that, um, going to Ethereum, L2s, in this case Optimism, made a great deal of sense. You At this point, like for the audience here, people were priced out of L1, right? Like this is the days of DeFi summer. Gas prices went up to 50. $50. You'd go to initiate a swap between one asset to another on synthetics, and you were priced out. So synthetics is path to L2 is really driven by a large amount of necessity. Obviously, there's a lot more to it, right? There's the ethos that align with building on top of an L2, which has this decentralized side that's built on L1, but it's driven by necessity. And the product offering that exists right now, with Synthetics V3 and with Synthetics Perps and these option protocols and structured products and everyone else, that's built within the ecosystem, right? You can't do this sort of trading and deliver it to retail traders, like regular folks that are not trading in size. You can't deliver that to folks on Ethereum mainnet, right? Like it's impossible. Like I would say that if you were to look at the volume of synthetics, 99% of it is coming from Optimism. And with this move to Andromeda, on base, we expect that to continue to be the same, right? Like we expect 99.9% to come from, Optimism and base, right? Because this is where users can trade. And there's no way that you're like, even now, there's no way that you're going to have these low latency oracles and everything else on Ethereum mainnet in a way that makes sense for a regular, small trader, right? For like, Athena and these like delta neutral, perps, like stable coins and things like that, that's fine. Like they will build on top of Synthetics Perps on L1. Like there's an offering being built out specifically for these sorts of large protocols that are fine taking on the disadvantages of building on L1. But yeah, for most traders and for most onboarding developers and everything else, I expect that the future of this will continue to be built on L2 scaling solutions.
Yeah, that makes sense. So, kind of going back to governance of synthetics, can you kind of talk about how the governance on synthetics is structured and how that kind of allows you guys to do what you do?
Yeah, definitely. So the synthetics governance model is this representative council model, and it's broken up into a couple councils that deal with different needs. So the most prominent council, the most known one, is the Spartan Council, and the Spartan Council votes on synthetics improvement proposals. It votes on parameter changes and things of that nature. And I'll just quickly go through the councils and then I'll run through the voting for them. So then you have the Grants Council that deals with distributing, grant funds to people building in the ecosystem, tooling within the ecosystem, things of that nature. Then you have the Ambassador Council that deals with making sure that synthetics' interest in other protocols' governance are, properly heard and properly understood. And when ambassadors also help out with onboarding additional protocols and things of that nature. And then there's the Treasury Council, which deals with day-to-day liquidity needs, stipend payments, payments to core contributors, things of that nature, right? Like the ongoing continuity of the protocol is what I like to think of as the Treasury Council. And all of these councils are elected by synthetic stakers every 4 months, which we actually have an election coming up, very soon. Within the next couple of weeks, there'll be another election for these councils. Um, Folks will be, reelected. So, yeah, all these councils are elected by synthetic stakers. The people that nominate themselves to run for them, they don't have to have any special qualifications. You don't even have to have any SNX tokens. Nothing. Like there's no gating here in terms of the process. If you're a long-time community member and you run for the Spartan Council and you've got some great ideas on how you want to see the protocol, go in this direction or that direction, you could do that. And we've seen many long-time community members jump in, potentially stay in for 4 8 months and then cycle out. Maybe they'll go to a different council. Maybe they'll just stick around but don't want to be involved in the day-to-day side of things. And I think that this model, to me, is one of the best models in DeFi, is because of how flexible and how fluid we can be with this representative, style, right? Like you don't need every token holder to vote on things, and you also don't need this weird thing where like we tell people you have power and governance, but just like seven whales vote and like your vote doesn't matter. Like at the end of the day, these representatives are voted in by stakers. And it could just be a regular staker who's only been in the community for 3 6 months, could even be, a little bit longer. And these are the folks that are making decisions. And once they're elected, the only real like check on if they're doing what you want them to do is the next election, right? So it's not like you elect this person and then a whale can just like cancel their vote. It doesn't matter anyway. Like this is a real, powerful system that we've seen real contentious proposals work through. I also really like to say that the litmus test of governance is, can your founder, Kane Warwick in this case, can he attempt to push a proposal through governance, and can he be properly rebuffed? And in Synthetic's case, the answer is yes. Synthetics is like the Spartan Council has rebuffed Kane on many occasions. Like he has tried to push a proposal through, but he said, this is a great proposal. I want to see X, Y, and Z. And the Spartan Council is like, either they'll negotiate and say, hey, we want to see X, Y, and Z parameters added to this, or they'll just say, no, like we hate your idea, and that's the end of that. And that's got to be very hard, like this is your baby, and you're watching your creation. You've decentralized your creation, and now you're watching them tell you, like, wait, we don't like this particular idea, and we want to go a different direction. It's happened many times, and that to me in DeFi is this real litmus test in governance that not many protocols have allowed themselves to really go through. Right? Like I don't think there's many other protocols that can say, hey, we let our founder write a proposal and then he just was told no. And he didn't just like blow everything up, like there's not many that are like that. And I think that's the most amazing part of the synthetics community and the synthetics, representative councils that we've seen.
Yeah, I feel like governance is not completely figured out in DeFi, and what you guys are doing is really cool and like a lot better than just token voting every proposal that's kind of going out there. So, can you kind of talk a little bit about like why you got into crypto in the first place, and like kind of because it's kind of like a non-consensus thing to get into crypto. So, like, what kind of got you interested in crypto in the first place?
Yeah. So my entry into crypto, I think, is probably similar to a lot of others. Like I saw Bitcoin as this really, I actually initially saw Bitcoin as this just way to make a little bit of money, right? Like I traded it probably in, oh my God, I want to say in like the 300 to like $600 range for years, right? I saw it as this interesting thing to trade, an interesting thing to sell to folks online, and like the early days of P2P trading and things of that nature. And that was like my entry. Like I just saw it as another very interesting entrepreneurial way to make a little bit of money, right? But the light bulb hadn't gone off yet, right? Like the light bulb only went off when you started to notice, like, wait, like this is a like Bitcoin is a real store of value, and in the Western world, it's kind of hard to understand like the lure of something like Bitcoin, right? When you have like the most liquid capital markets in the world, and your banks traditionally don't have problems. But once you start stepping out of that, that mind space, and you start looking a little bit further into countries that have super high inflation and things of this nature, you start to see synthetics. You start to see Bitcoin as this like amazing use case that we've needed for the longest time. Now, I would say that I was probably a Bitcoin maximalist for some amount of time. Probably, I think that's how many people are when they get into they get into the industry, especially because you look everywhere else and you're like, what are all these random scams doing? And that was the early days of crypto. It was just a bunch of like it was a lot of shit projects that weren't really doing all that much. But then when you looked a little bit further, and I started to see the sorts of technology that was being built on Ethereum, that opened my eyes to like, wait, we're not just building like the future of money. Like we're building the future of finance and the future of like decentralized apps. And as I said to you before, like, when I first got involved in the space, like it was just using, early liquidity pools and yield aggregators. Like, yet again, I was interested more in the financial side of it, but it was like, oh my God, like look at how amazing all this is, and it can all be tracked on chain, and I don't need to, trust anyone. I can go look at the code myself. And that's how I initially got hooked on synthetics. I initially got hooked on synthetics from the liquidity mining rewards that synthetics is known for pioneering. At this point, but back then it was just this really interesting test and seeing like, wait, we could kind of bootstrap, curve pools with taking the native token and using it to incentivize behavior. Um, and that was like my entry into synthetics, and then um, I always like to give the context of my hiring at synthetics into this like comms, and marketing, and it's not just that. There's a lot more that goes on. I think in any decentralized group, you help out with a wide array of things because you just love the project, the idea so much. But my entry into synthetics was just as a community member. Like I was a community member for probably 2 years before I was hired to help out as a core contributor. I had just started a Twitter account and started, filling a gap that I thought I saw in communication, and started explaining different topics about synthetics and about DeFi and about the apps built on top of synthetics, and how I wanted to see the protocol go. I would go to live, I would go to like, public calls and just start like live tweeting them. And then after a little bit, all this sort of community led work just started to really take off, and that was like my entry into the world of working in DeFi. But yeah, I went to uni for something completely unrelated. I was an accounting major. I was probably very close to working in Big Four, just like probably many folks are. And then you take a little bit of a different path. So yeah, hey, it's been a fantastic path, and I think to anyone listening that's interested in getting into DeFi, like I said this 2 years ago when I first got hired, and I'll say the same thing now. If you want to get involved, find a space, find something you're extremely passionate about, and then from there, work through the ways that you could add value to it. Right? You don't have to dedicate like large amounts of unpaid time, but see where you can support from a community aspect, and people will take notice of these things. Like this is how DeFi works, right? Like it's so much easier to hire someone from the community that has years of context compared to taking someone from a traditional role, trying to teach them all this crazy crypto, DeFi culture and everything else, and then trying to, get them into the workforce. It's a much harder thing to do.
Yeah, 100%. Can you kind of talk about like what's on the horizon for synthetics and kind of what like has you excited for, I guess, synthetics and kind of crypto going forward?
Yeah, yeah. So the biggest thing on the horizon for synthetics was just announced the other day. Just announced, I want to say yesterday, that the synthetics Andromeda release that, as I said before, will bring, core V3, perps V3, and USDC as collateral, and this fee share testing, and this integrator fee share testing and everything else. That'll happen during the month of December. So that to me is this like very exciting short-term test that we can start to see what being on a new chain is like properly, being a multi-chain protocol with our entire offering there, and then seeing developers and our existing ecosystem build out over there, right? Like you're going to have Quenta, you're going to have Polynomial, you're going to have, you're going to have Infinex build over there as well. And we're going to see the differing ways that these protocols go about onboarding users, right? And that's a very interesting thing to witness from this like generalized, infrastructure layer that Synthetics is going for now. And we'll work on, tailoring the offering as much as possible, and amping up as much liquidity as we can, and supporting the infrastructure as much as we can. But that's really this first stage, right? Like Andromeda is the first stage of this, but the next stage is Synthetics V3 coming to Optimism, coming to Ethereum mainnet, and seeing like the real offering continue to like exist in a way where we start to see an abundance of markets across derivatives built atop synthetics, right? Like I think a lot of people forget that perps is only like one part of the offering, right? Like we want to see this like this wide wide opening of derivative apps built atop synthetics. We want to see there's a blog post that lays out some of these example markets, but we want to see perps, we want to see options, we want to see spot trading, we want to see insurance markets, lottery markets, things like pool together. We want to like there's such a wide array of apps that can be built on synthetics, and once we get to the point where I would say, once Andromeda is released and Perps begins to see adoption on base, and we get to see how that experimentation works out, you'll get to a point where you could kind of take the shackles off some of this, and make all of this permissionless. Because as of right now, if you want to start a new pool and a new market, like a pool together liquidity and a market to actually handle what derivative you want to build, those still have to go through governance as of right now. But in the future, that's going to be removed from governance, and we're going to see, what people build on top of this infrastructure in a way that, synthetics governance isn't, shackling down in some sort of way. So that's the real exciting next part. That's, with synthetics v3, the usage of, USDC as collateral, the usage as ETH as collateral, liquid staking tokens as collateral, and then seeing this large array of derivatives built atop synthetics, and then onboarding as many developers as we can. Like that's the real goal, and that'll be the real push over the next 6 months to a year. Just getting as many developers building on top of synthetics, and seeing the benefits of having liquidity abstracted away and infrastructure abstracted away, so they can focus on building the best offering, right? Because there's so many great developers in the space, there's so many great protocols, but they've died at the hands of a lack of liquidity, right? If you have no liquidity, you have no traders. If you have no traders, you have no liquidity. And Synthetics is hoping to solve that liquidity problem, so everything that you do can be focused on onboarding traders and having the best market design out there. So yeah, it's going to be an exciting, couple months as Andromeda comes out, and then it's going to be an exciting 6 months, a year, 2 years as Synthetics v3 and all these derivative apps begin to take shape.
That's awesome. I think this is a great way to end things. Thank you for coming on the podcast.
Yeah, thank you for having me. I appreciate it. If you guys want to, keep up to date on anything synthetics, follow synthetics on Twitter. I hope you already are. If you're a long time DeFi user, and then just join the Discord and just track the overall conversation. There's a lot going on, but a lot of good educational pieces on synthetics V3, Andromeda, and everything else. So yeah, Jack, thank you again for having me on. I appreciate it.